So, do they make life alert for the stock market? Because it surely has fallen and it can't get up. Wow, I think I just set a new low for myself. That was not even funny. But seriously, does anybody have a pulse on the stock market right now? It seems like every time the stock market tries to stand up, it just gets pushed back over and we fall even further than we were before. It seems like there's no end in sight. And something that you guys might not realize is that this correction has actually been taking place for over a year now. Despite the indexes like the S&P 500 and the NASDAQ being basically at all-time highs throughout 2021, what was underneath the skin of those indexes was very hard to look at. And that's because towards the end of the year, over 50% of the stocks that make up the S&P 500 were at 52-week lows, and the same can be said for the NASDAQ. The reason for this is because the biggest companies in the world, they make up such a large portion of those indexes, and because they performed pretty well last year, so did the indexes. They flat out carried the indexes. So over the past year, as I've been dissecting this, I realized that the indexes would likely have to correct eventually, and I've been predicting this for a long time, but I've been wrong in thinking that this would help out the high growth stocks that were getting bashed in 2021, because those high growth stocks keep getting bashed despite the indexes finally correcting and coming back down. So on my YouTube channel, I've found that my viewers absolutely love when I dig into the exact details and facts of what's going on in the stock market, and that's exactly what I'm going to be doing in today's video. But before I dive into this, I just want to say, if you guys are new here or returning by chance and not yet subscribed, I would greatly appreciate you hitting that subscribe button down below, and also leave a comment what stock you have been buying heavily on this correction in the stock market. But without further ado, I don't want to waste any more of your time. Let's go ahead and get into this. So as I've already hinted at, it really hasn't mattered how much cash or growth or profitability a company has. The stocks have just been thrown through the slammer so far in 2022. Literally everything is crashing. It doesn't matter what it is, what the company does, everything is crashing. So first of all, this is not just speculative stocks that are getting hurt. This is literally everything. This isn't company specific. This is macro environment that is hurting the stock market right now. I'll be going through the two main reasons I believe the stock market is in a sell-off currently, and why I believe we could actually be kind of in a standstill for the next few months. But if you guys get bored of whatever I'm talking about in this video, please feel free to skip ahead. I'll leave timestamps down below, separating this first reason from the second reason. So if you get bored of this first reason, feel free to skip ahead to that second reason. My feelings won't be hurt. So, reason number one the market sold off today in particular, but also have been selling off, is because the Treasury yields and the bond yields have been rising. In fact, just today, the U.S. 10-year Treasury yield hit a 2-year high at 1.875% currently. The reason Treasury and bond yields are rising across the board is because investors are demanding that higher yield to compensate them for the increased inflation risk. Remember, just last month, we got numbers that showed we had 7% inflation year over year in the month of December. That is a lot of inflation. And to help accommodate for that, the investors that are investing their money are demanding that higher yield to offset any future inflation. It's pretty much common sense, but whenever the potential return of an investment goes up, money is going to cycle into whatever investment that is. And for example, the U.S. 10-year Treasury yield, despite it only yielding investors 1.875%, money is going to flow into that investment. And that is because investors have different risk tolerances. When you see 1.875% return, you might scoff and say that is nothing. But you have to remember that that 1.875% is a guaranteed return. In the stock market, even dividends you get paid aren't guaranteed. A company can cut their dividends anytime they want. In the stock market, you don't have guaranteed returns. But with treasuries and bonds, you do, which is generally why the return is lower, because you have that guaranteed return. But again, because if you buy treasuries and bonds right now, you will be yielding more money. Money is going to flow into it because it's a better opportunity than it was previously. And guess what? The money has to come from somewhere. And it comes out of the stock market generally and into the treasuries and bonds. And with the way the stock market is reacting to this news that the U.S. 10-year Treasury yield hit a 2-year high of 1.875%, you would think that, stock investors feel this is the end of the world because the sell-off continues. But if you zoom out, you'll see there is no reason to be worried about this. Ever since the 1980s, yields on treasuries and bonds have consistently fallen. And this is because the United States of America continues to take on more and more debt. So the government continues to auction off more and more treasuries to help service that debt for cheaper. So in the current environment, as long as things aren't changed dramatically from how they work now, there is simply just no way that the treasury yields and bond yields are going to go back up to 15%. And again, just to cover this for a second time, if we take ourselves back to the 1980s, back when the US 10-year Treasury was yielding investors 15%, do you think investors were going hand over fist into the stock market? No, because they could get a guaranteed 15% return on the US 10-year Treasury back in the 1980s. So, if more money is cycling back into treasuries and bonds, the money is coming out of the stock market more than likely, which is why stocks have been falling as the 10-year Treasury yield and yields across the board have been rising. So I already covered briefly that the reason the yields are increasing is because of inflation fears. Investors are demanding a higher return to account for that inflation risk with investing in bonds or treasuries. So this market sell-off, in my eyes, is purely driven by inflationary fears. And rightfully so. Again, just last month we got December's numbers telling us that inflation year over year was 7%, which is very, very high. So now you may be wondering, okay, if this is driven by inflationary fears, how do we get inflation to go down? And this leads me into my second reason that stocks are falling right now. And it's because the Fed and Jerome Powell are in a very, very tough and difficult situation. And the markets see this, which adds more fear to the stock market, leading to even more selling. The only surefire way to combat inflation entirely is to raise interest rates. In fact, for every 1% of inflation there is, to completely offset that 1% of inflation, you have to raise interest rates 1.5%. So if we think about this, last month the numbers for December were 7% inflation year over year. So to combat that 7% entirely, the Fed and Jerome Powell would have to raise interest rates to 10.5%. But the reason there is no way this is going to happen is because, again, you would destroy the economy if you rose interest rates that high. And this is because the cost of capital goes through the roof. Think about it. Investors and individuals and businesses can't borrow money for cheap. It's very expensive to borrow money that they need to grow their business or finance their household. And if people can't get access to capital, the economy can go straight downhill very, very fast. Raising interest rates to 10.5% may indeed completely stunt inflation, but the Fed and Jerome Powell are not going to do it because they don't want to destroy the economy. Nobody wants that tag behind their name, being the Fed chairman that destroyed the economy. Joe Biden, the elected officials, they don't want to have that tag behind their name. That under my presidency, I destroyed the economy because I rose interest rates. I hiked interest rates. Nobody wants to do that. So Jerome Powell and the Fed is in a situation right now where they have to be extremely careful with the buttons they push and when they push those buttons. They don't want to raise interest rates too high because it destroys the economy, but they don't want to leave interest rates untouched more than likely because inflation seems to be running rampant, and you don't want inflation to be running away because that in turn also destroys an economy. Because no matter how hard somebody works, no matter how much cash somebody has, you're losing your purchasing power for every dollar you have. You're basically getting inflated away out of your own lifestyle, which is not good and again destroys the economy. So the Fed has to be very, very careful, and the market sees this, and it's adding fear into the markets, causing even more of a sell-off. Just to add to the chaos, the Fed also has to worry about how much inflation will naturally come down as supply constraints ease and get worked out. Think about it. How many different items have been pushed up in price because there's not enough of it, because the supply chain is constrained and there's supply chain bottlenecks? New vehicles, the supply has been bogged down because of supply chain issues with microchips. And guess what has happened because of that? Well, the prices of used vehicles have inflated to record highs because the demand for used vehicles has gone up because you simply cannot buy new vehicles as easy as you used to be able to. So naturally, prices have risen. But when that supply chain constraint is worked out and the auto manufacturers can finally match the demand with supply, how much of that is going to put deflationary pressure on the prices of used vehicles? That's going to be a deflationary pressure on the economy and the year-over-year inflation rate going forward. And that's just one example. We could discuss meats and how packing plants have been shut down and they're way behind because they can't push out enough meat. So the prices of meats have also risen. But what happens when the packing plants open back up and they catch back up to the demand and they're all of a sudden back to production levels they saw before the pandemic? Well, prices of meats is likely going to fall back down, putting deflationary pressure on the economy, but also the inflation rate moving forward yet again. So those are just two examples. I could go on and on and on about this, but no matter what, there is going to be some natural deflation in the economy. And the Fed has to look at it and debate how much of this is going to help us out, and as a result of however much it helps us out, how much do we need to raise interest rates? There's a lot of uncertainty right now surrounding so many different things, and whenever you get uncertainty and fear and doubt in the markets, guess what? A sell-off happens. Unreasonable valuations happen. But the smart investors are the ones that scoop up the opportunity, buy into the opportunity, and are patient with it. That's the key ingredient that most people miss, is patience. Right now, even the bears in the stock market aren't convinced that these valuations are going to stick. Valuations are getting pretty ridiculous for a lot of companies, and if you're talking to a smart bear or a smart short seller, they know that probably even just a year from now, the valuations are going to catch back up to where they need to be. So, buy the dip, have patience. Again, not financial advice. That's just what I am doing. With that, I hope you guys really enjoyed this video. If you did, leave a like down below. Also, don't forget to comment what stock you're buying up like crazy right now in this environment. With that, I hope you have a great rest of your day and peace out.